I've spent most of my life sitting in front of price, watching it breathe, watching it lie to men who wanted comfort instead of truth. And if there is one habit that ruins more good trades than bad analysis ever could, it's the habit of overstaying a winning position. Not because the trader is greedy. No, greed gets too much blame, but because he is afraid. Afraid of regret. Afraid of seeing the market go a little farther without him and feeling foolish for selling too soon. Have you ever noticed how that fear sneaks in right when things are going well? When a trade begins to work, the tape speaks clearly. Price moves in your favor, volume confirms, the market does exactly what you anticipated. At that moment, the hard part is already over. The risk has been taken, the decision made. And yet, that is where most traders begin to hesitate. They stop listening to the market and start listening to themselves. Instead of asking, "What is price telling me now?" they ask, "What if it keeps going?" And that question has nothing to do with logic. I learned early that the market does not reward hope, and it does not punish caution. It only exposes weakness. When a man stays in a trade past its proper time, he is not being patient. He is bargaining with his emotions. He tells himself that trends last forever, that this move is different, that selling now would mean leaving money on the table. But tell me, have you ever noticed how that table is always imaginary? The money you think you left behind never belonged to you. The market gives opportunities in measured doses. It never hands out certainty. A winning trade has a lifespan, just like a losing one. The difference is that losing trades hurt the ego immediately, while winning trades tempt it. And temptation is far more dangerous. When price starts to stall, when momentum thins, when the crowd grows loud and confident, those are not signs of strength. They are warnings. Do you really think the market announces the end of a move with a bell? I have seen men sit on profits and watch them evaporate, not because they lacked a plan, but because they lacked the nerve to follow it. They were afraid that closing the trade would expose them to regret. They imagined price exploding higher the moment they sold, and they could not bear that picture. So they waited, and while they waited, the market quietly changed its mind. It always does. This is the great irony of trading. Fear does not only live in losses, it lives in gains. A man who is comfortable taking small losses, but refuses to take solid profits is still ruled by fear. He wants the market to validate him, to praise his patience, to prove he was right beyond doubt. But the market does not care about your need to be right. It only responds to supply and demand, and those forces turn long before your feelings do. When I was younger, I thought the goal was to catch the entire move. That idea ruined more trades than bad timing ever did. No one catches the top, just as no one catches the bottom. Not consistently, not without luck. The professional's job is not perfection, it is extraction. You take what the market offers while conditions are favorable, and you step aside when they are not. Isn't it strange how traders understand this intellectually, but forget it emotionally? Charts are honest. They show you when price accelerates, and they show you when it hesitates. A series of strong bars gives way to overlapping ranges. Volume dries up. The trend loses urgency. These are not mysteries. And yet, traders ignore them, because closing the trade feels like an admission that the move might continue without them. That fear of missing out is just another name for fear of regret. Wealth in trading is built the same way fortunes are built anywhere else, by repetition of sound behavior. One good trade does not make a career, and one missed extension does not break one. But overstaying winning trades creates a dangerous habit. It teaches the mind that discipline is optional when things feel good. And once discipline becomes optional, it eventually disappears. I have always said that the big money is made by sitting, not by trading. But sitting does not mean clinging. It means staying with the trend while it is alive, and leaving it when it begins to weaken. Sitting requires attentiveness, not stubbornness. Can you see the difference? One listens to the market, the other argues with it. Every time a trader turns a gain into a scratch, or worse, into a loss, the market is giving him a lesson. Not a punishment, a lesson. It is showing him that fear of regret is more powerful than fear of loss. Loss is visible and immediate. Regret is imagined, but it feels just as real. and most men would rather endure real pain than imagined embarrassment. This is why money mindset matters in trading. If you believe profits must be maximized on every trade, you will never take them at the right time. If you believe the market owes you continuation, you will overstay your welcome. The professional understands that capital is ammunition, not trophies. You do not display your wins, you recycle them. How many traders do you know who protect losses carefully but leave profits unattended? I have watched traders babysit a winning position as if it were fragile glass, afraid to touch it, afraid to close it, afraid to admit the move might be ending. They stare at every tick, hoping the market reassures them. But the market does not reassure, it reveals. And what it often reveals is hesitation. Over time, this behavior teaches the worst possible lesson, that profits are temporary and unreliable. The trader begins to distrust his own success. He starts to think that every win must be squeezed dry before it vanishes. And that belief leads straight to overtrading, overholding, and emotional decision-making. Does that sound like a foundation for long-term wealth? The irony is that the traders who accept small, incomplete profits often end up with larger accounts. They are not chasing glory, they are managing exposure. They understand that staying liquid is a position in itself. Cash has clarity, cash has patience. And patience is what allows a man to take the next opportunity without baggage from the last one. When you learn to exit a winning trade without apology, you take away the market's power over your emotions. You stop needing it to confirm your brilliance. You start treating it as a business partner, unpredictable, sometimes generous, sometimes stingy, but never sentimental. And once you reach that point, you begin to see opportunities not as events, but as parts of a long series, each one independent, each one requiring the same calm judgment. Fear of regret makes traders seek permission from price instead of acting on signals, and I have seen this behavior repeat itself more times than I can count. A trader studies a chart, identifies a setup, plans the entry, accepts the risk, and executes with confidence. But when the trade begins to work and the market moves in his favor, something subtle changes. The chart no longer feels like a guide, it feels like a judge. Instead of reading what price is doing, the trader waits for price to reassure him that his next decision will not make him feel foolish. Have you noticed how that need for reassurance only shows up after money is already on the line? When a man is afraid of regret, he no longer trades probabilities. He trades feelings. He watches every tick, not to gather information, but to see whether the market approves of him staying in the trade. If price moves a little higher, he relaxes. If it pauses, he stiffens. If it pulls back slightly, he tells himself it is just a normal reaction. All the while, the original signals that justified the position are fading, but he refuses to acknowledge them because acting now might create regret later. And regret, in his mind, is worse than giving back profits. The market never grants permission. That is one of its most consistent traits. It does not tell you when a move is complete. It does not notify you when momentum is thinning. It simply changes character. The professional learns to recognize that change and act without hesitation. The amateur waits for confirmation that can only come after the opportunity has passed. Why do so many traders think the market owes them clarity at the exact moment they feel uncertain? Fear of regret is sneaky because it disguises itself as patience. The trader tells himself he is being disciplined, that he is letting the trade work, that he is not micromanaging. But discipline is not passive. Discipline is active decision, making based on observed facts. When price stops expanding, when volume no longer supports continuation, when the market begins to hesitate, discipline calls for action. Regret whispers that action can wait just a little longer until things feel more certain. And certainty is the one thing the market never provides at turning points. By the time certainty arrives, the best opportunity is gone. This is why traders who fear regret often exit only after profits shrink or vanish. At that point, the decision feels forced, and they tell themselves the market betrayed them. In truth, the market offered information, and they declined to use it. They were waiting for permission that never existed. I have always believed that the market teaches through repetition, A trader who repeatedly overstays winning trades is being shown the same lesson again and again. Each time, the message is the same: act when the signal appears, not when your emotions feel comfortable. Yet many traders respond by adjusting their expectations instead of their behavior. They say, "Next time I'll give it more room. Next time I'll hold through the pullback," without realizing that it was not the pullback that hurt them, but the hesitation. The chart does not care about your last exit. It does not remember whether you sold too early before, but you do, and that memory becomes a bias. The fear of repeating a past mistake pushes you to stay longer than you should, even when current conditions are different. This is how traders let yesterday's regret interfere with today's judgment. Have you ever noticed how the memory of one missed extension can outweigh a dozen well-managed exits? When you seek permission from price, you stop leading the trade and start following it emotionally. You allow short-term fluctuations to dictate decisions that should be based on structure and behavior. A small pullback feels like a threat. A brief rally feels like encouragement. The trader becomes reactive instead of deliberate. And reactive trading is expensive, not because the market is unfair, but because it is efficient at exploiting hesitation. Wealth building in trading depends on consistency of execution, not on squeezing every possible dollar from every move. A trader who exits well builds confidence in his process. A trader who waits for permission builds dependence on outcomes. Over time, that dependence erodes discipline. The trader begins to believe that good results justify poor process, as long as the market eventually bails him out. But the market does not always bail you out, and when it does, it teaches the wrong lesson. Fear of regret also distorts how traders view success. Instead of measuring success by adherence to rules and signals, they measure it by how much more the market did after they exited. This backward-looking mindset turns trading into an emotional scorecard. Every exit is judged not by logic, but by hindsight. And hindsight is cruel, because it always shows you what you could have had, never what you avoided. I learned long ago that the hardest words in trading are good enough. Taking a solid profit and stepping aside requires more strength than holding and hoping. It requires acceptance that you will never capture the full move, and that missing part of a move is not a failure. Traders who understand this stop seeking permission. They act when their conditions change, not when their feelings settle. The market respects decisiveness. It does not reward hesitation. When you hesitate, you introduce noise into your process. You begin second-guessing signals that were clear moments ago. You start adjusting stops not based on structure, but based on fear of being wrong too soon. And once fear becomes the driver, logic takes a back seat. There is a quiet confidence that comes from exiting a trade cleanly, even if price later goes a little farther. That confidence does not come from being right about the market's next move. It comes from being right about your own behavior. When you stop needing permission, you stop fearing regret, because regret loses its power when you trust your process more than the outcome. Most traders think regret comes from getting out too early. In reality, regret comes from knowing you ignored what you saw because you were afraid to act. That feeling lingers far longer than the memory of a missed extension. The trader who understands this stops arguing with the chart and starts responding to it. He no longer waits for the market to make the decision for him, because he knows that by the time it does, the decision has already been made, and it is rarely in his favor. The more you trade, the more you realize that hesitation is not neutral. It tilts the odds against you. Every moment you delay an exit after conditions change is a moment you are exposed without compensation. You are risking open profit for emotional comfort, and emotional comfort has no place in a profession that demands clarity under uncertainty. When fear of regret fades, trading becomes quieter. Decisions feel cleaner. Exits feel deliberate rather than forced. You stop staring at price for approval and start observing it for information. And that shift, subtle as it is, changes everything about how you engage with the market. Because instead of asking whether price will make you feel bad for leaving, you ask whether staying still makes sense based on what the market is doing right now. And once you begin asking that question honestly, You start to see how often the answer appears long before you ever wanted to hear it, long before the market makes it obvious, long before your emotions are ready, and that moment, when logic is clear but action feels uncomfortable, is where the real work of trading begins, because it forces you to choose between protecting your process and protecting your feelings, and that choice repeats itself trade after trade, day after day, shaping whether you become a man who waits for permission or a man who acts when the signal is present, even if it means walking away while the crowd is still watching, still hoping, still believing that the market will give them one more sign, one more push, one more reason to stay, even though the only reason they are really waiting is because they do not want to look back and wonder what might have happened if they had held on just a little longer. And so they keep watching and waiting and asking price to decide for them, instead of accepting that the decision was already theirs to make the moment the market stopped behaving the way it did when the trade was young and full of promise. And the longer they ignore that shift, the more they teach themselves to distrust their own judgment, until eventually every winning trade becomes a negotiation rather than an execution, and every exit becomes delayed by the same quiet question that never gets answered by the market, no matter how long they wait. A winning trade can become emotionally dangerous the moment it feels safe, and that is something most traders never see coming. When a position is new, risk is clear, you know where you are wrong. You know how much you can lose. Your mind is sharp because danger is present. But once price moves in your favor and unrealized profit appears, the sense of danger fades, and in its place comes comfort. And comfort has no place in speculation. Have you ever noticed how your sharpest thinking often disappears right when the trade starts working? The feeling of safety changes how traders read charts. Early in the trade, every candle matters, every pause is analyzed. But once the trade shows a comfortable profit, the trader stops reading price and starts assuming outcomes. Pullbacks are ignored. Weak volume is excused. Structure breaks are minimized. The trader tells himself the trend is strong because it has already paid him. That logic is backward. The market does not continue because it has rewarded you. It continues only if buyers and sellers remain unbalanced. This false sense of safety is what turns a professional decision into an emotional attachment. The trade stops being a position and starts feeling like property. The trader begins to think of the profit as his, even though it is still floating, still controlled by the market. And once ownership enters the mind, objectivity leaves. Why is it that traders guard their unrealized gains more fiercely than their capital, even though only one of them actually exists? When a trade feels safe, rules soften. Stops are widened, not because the chart demands it, but because the trader does not want to be taken out. Targets become flexible, not because conditions have improved, but because greed is disguised as confidence. The trader says he is, letting it run, but in reality, he is avoiding the discomfort of making a decision that could later feel wrong. Safety makes him passive, and passivity is expensive. I have seen more damage done by comfort than by fear. Fear at least makes a man cautious. Comfort makes him careless. A trader who feels safe stops managing risk actively. He believes the market has proven him right and will continue to do so. But the market proves nothing. It moves, and movement changes. The transition from trend to balance is often quiet, subtle, and easy to miss, especially when you are relaxed. This is why winning trades require more discipline than losing ones. Losses force action, wins invite delay. A losing trade hits your stop and removes itself. A winning trade stays open and demands judgment. That judgment must be sharpest when emotions are calm, because calm is deceptive. Calm tells you nothing needs to be done. Calm whispers that you have time. And time is exactly what trends take away when they end. A trader who mistakes safety for certainty begins to plan around profits instead of price. He starts thinking about what the money could become, how much it might grow, what it would mean for his account. Those thoughts have nothing to do with the chart. They pull attention away from structure, momentum, and behavior. The trader is no longer trading the market. He is trading a fantasy built on unrealized gains. The dangerous part is that this behavior often works. At first. The market continues a little farther, reinforcing the trader's belief that holding through hesitation is wise. That reinforcement is poison. It teaches the trader that ignoring early warning signs is acceptable as long as price eventually moves his way. But markets are inconsistent teachers. They reward bad behavior just often enough to make it stick, and then they collect payment when conditions change. When a winning trade feels safe, traders also stop preparing for exits. They do not rehearse decisions. They do not define what would change their mind. They assume the exit will be obvious when the time comes. But exits are rarely obvious in real time. They are clear only in hindsight. Without predefined conditions, the trader freezes when price starts to wobble. He waits for the market to make the decision for him, and the market never does so kindly. The illusion of safety also alters time perception. Minutes feel shorter, consolidations feel temporary, reversals feel unlikely. The trader underestimates how quickly profit can disappear because it took time to build. But the market can take back in hours what it gave over days. Safety dulls urgency, and urgency is essential for protecting gains. Money mindset plays a role here. Traders who believe profits must always be maximized are especially vulnerable. To them, exiting early feels like failure, even if the trade was executed perfectly. That belief turns safety into a trap. The trader holds not because the chart supports it, but because letting go would challenge his identity as a good trader. Have you ever seen a man hold a winning trade longer just to prove he was right? The professional understands that safety is an illusion created by distance from risk. As price moves away from entry, the pain of loss feels less immediate, even though the exposure is still there. That emotional distance makes the trader careless. He forgets that the only thing protecting his profit is his willingness to act. The market offers no protection. It simply waits. Over time, traders who grow comfortable with winning trades develop a dangerous habit. They associate success with inaction. They believe the best trades are the ones where they do nothing. But doing nothing is only correct when conditions remain unchanged. When conditions shift, doing nothing is a decision, and often the wrong one. The trader who fails to see this distinction becomes passive at precisely the wrong moment. I learned that the moment I felt relaxed in a trade was the moment I needed to pay closer attention. Comfort was a signal, not a reward. It told me my guard was down. It told me I was no longer questioning assumptions. And the market punishes unchallenged assumptions more reliably than it punishes fear. A winning trade demands active observation until it is closed. The moment you stop observing and start assuming, you give up control. The trade begins to manage you. You start reacting emotionally instead of responding logically. And once that happens, exits are delayed, profits shrink, and lessons are learned the hard way. There is nothing wrong with enjoying a winning trade. But enjoyment must never replace vigilance. The market has no memory of how well it treated you 5 minutes ago. It does not care that the trade has been easy so far. Ease is not strength. Often, ease is the final stage before effort returns in the opposite direction. Traders who survive long enough learn to be suspicious of comfort. They learn that safety is not something the market provides, but something discipline maintains. They stay alert when others relax. They tighten focus when others celebrate. And they accept that the most dangerous moment in any trade is not when it is losing, but when it feels so safe that they stop asking hard questions about what price is doing right now, how behavior is changing, whether momentum is still present, whether participation is fading, whether the trade still deserves their capital at this moment, rather than 5 minutes ago, rather than an hour ago, rather than at the moment they first entered. Because the market only exists in the present, and the moment you trade the past comfort of unrealized gains instead of the current behavior of price, you step into a position where emotion quietly replaces analysis, where comfort dulls discipline, where safety becomes a story you tell yourself to avoid making a decision, and that story grows more convincing the longer the trade stays open, until eventually the market interrupts it without warning, not because it is cruel, but because it is indifferent, and indifference is the one constant every trader must learn to respect if he wants to survive long enough to understand why the trades that feel safest are often the ones that demand the most attention. Traders protect losses with rules, but expose profits to hope, and that contradiction sits at the center of most trading failures. Nearly every trader I've known can recite his stop-loss rules without hesitation. He knows exactly how much he is willing to lose, where he is wrong, and when the trade must be abandoned. Loss is treated with seriousness and structure. Profit, on the other hand, is treated like a suggestion. Why is it that discipline is firm when money is being lost, but flexible when money is being made? The moment a trade turns profitable, rules often soften. The trader who would never widen a stop to avoid a loss will gladly delay an exit to avoid leaving money behind. He tells himself he is being patient, that profits should be allowed to grow, that the market deserves room. But what he is really doing is replacing rules with hope. Hope that the move will continue. Hope that the market will reward him further. Hope that waiting will feel better than acting. Hope is dangerous because it has no structure. It cannot be tested or measured. It does not come from the chart, it comes from desire, and desire has no place in risk management. A trader who protects losses but leaves profits unmanaged is only doing half the job. He is controlling downside while allowing upside to be dictated by emotion. That imbalance slowly erodes consistency. Losses are easy to respect because they threaten the account directly. Profits feel less urgent because they appear to be a cushion. The trader feels ahead, and being ahead creates a sense of flexibility. He believes he can afford to wait, afford to give it more room, afford to see what happens. But unrealized profit is not a cushion, it is exposure. The market can remove it just as easily as it delivered it. Have you ever noticed how quickly a comfortable profit can disappear once momentum shifts? The irony is that traders often manage losing trades better than winning ones. Losing trades are planned. Winning trades are improvised. The trader enters with a defined risk but exits with a moving target. He adjusts expectations instead of responding to price. Over time, this behavior creates uneven results, small losses and inconsistent wins, where the size of the gain depends more on luck than on execution. Protecting losses with rules is necessary, but it is not sufficient. Trading is not just about survival, it is about extraction. And extraction requires just as much discipline as defense. A trader who fails to define how profits are handled is leaving the most important part of the business to chance. Hope becomes the manager of the trade, and hope is unreliable. The market is indifferent to your profit. It does not know when you are up or down. It only moves according to participation and pressure. When that pressure fades, profits are at risk. The trader who continues to hold because he hopes pressure will return is no longer responding to information. He is waiting for a favorable outcome to justify inaction. This is where money mindset reveals itself. Traders who believe profits are fragile tend to cling to them emotionally. They fear that taking profit will end the good feeling, so they delay it. They want the trade to keep working because it confirms their competence. That desire clouds judgment. Instead of asking, is this trade still valid? They ask, what if it goes higher after I sell? Hope also disguises itself as optimism. The trader convinces himself that positive thinking will somehow influence outcomes. He focuses on bullish scenarios and ignores warning signs. He reads the chart selectively, highlighting strength and dismissing weakness. This selective perception is not analysis, it is self-deception. The market does not reward optimism, it rewards accuracy. A well-managed profit requires predefined conditions, just like a well-managed loss. It requires knowing what would cause you to exit, what behavior would signal exhaustion, what change in structure would invalidate continuation. Without these guidelines, the trader drifts. He holds until something forces his hand, often a sharp reversal or a sudden loss of momentum that catches him unprepared. Over time, this approach teaches the wrong lessons. When a trader gives back profits and then exits, he tells himself the problem was volatility, bad luck, or manipulation. Rarely does he admit that he exposed profit to hope instead of protecting it with rules. And because the lesson is misidentified, the behavior repeats. There is a quiet discipline in taking profits without drama. It does not feel heroic. It does not create stories. It feels ordinary. That ordinariness is what many traders resist. They want trading to feel significant, exciting, validating. Hope keeps that feeling alive. Rules end it. And yet rules are what build accounts. The professional understands that profit is a liability until it is realized. It must be managed, defended, and secured.